Welcome. This is Business Now, a product of the Oklahoman's Business News Department. This show addresses current business issues that are relevant to you, our users and readers of the Oklahoman. It's sponsored by Bank of Oklahoma. I'm Clyde Bunyan, business editor, and joining me today are Mark Funke, president of BOK Oklahoma City, and Greg Wheeler, CEO of private banking for BOK Financial. Gentlemen, welcome.
It's great to be with you this morning.
Thank you. Well, it's been quite an interesting time we've been having here lately in the financial markets. Why is the market the way it is? What would have happened if the president didn't sign the bill, if the bill didn't pass?
Well, I think there's a couple of you have a couple of questions in there. Let me start with the first one. The bill passed. It did pass. It is but one step in a process. It is not that the bailout bill is not the end all be all for anything, any of the economy, and for the most part, there'll be required to be other steps that have to be taken by both the government and by companies in general to get us out of the position that we're in. The volatility will continue. There's no doubt about that. It'll probably continue. We expect through early spring, you'll continue to see things until the Fed lowers rates. Which that's built into the market today. There's a 50 basis point decline in interest rates built into the forward curves until there's some other technical things addressed in the Fed with our central bank. One of the biggest of those has already been addressed, and that's the paying of interest on deposits held at the Fed.
One of the things I've been wondering about, and we've heard people talk about, is with these wild swings on the market, why haven't we been seeing curbs in trading?
I don't think the government wants to put any additional. I mean, if the market got completely out of whack, I'm sure they would cease in that. But at this point, I don't think that's probably something the regulators want to do.
Yeah.
There are market curbs built in, but they're based on percentages. And as a result of the percentage swings, we haven't seen that big of a decline relative to what happened in October of 1987. And so I think if we do hit those percentages, the curbs will come into effect.
Yeah. So the 700-point swing we had a week ago, that's not a huge percentage swing.
Not when you think about where the Dow was, as an example, in 1987. It was roughly around 7,000, 6,000, 7,000. And so a percentage swing is 700 points is not that big of a deal.
Talking about the markets, we hear a lot about that we're in for a long haul in a bear market. Where do you guys see the markets being at the end of the year? By the end of the year. But that's short enough term.
Well, I left my crystal ball at home, back at the office actually this morning, but I think you'll see the markets continue to fluctuate wildly, but we'll fall within a trading range of, we expect that we'll be about flat by year end from where we are right now today.
One of the things we're also concerned about is banks, as you said, not lending to each other. You know, that it was kind of, the squeeze has been put on that there for a while. It's a little tight. But the rescue package, the bailout package, is supposed to address all those issues, or to help get things going again. Since that would be done sort of behind the scenes per se, when will we as the public know that, okay, banks have resumed starting to get that money flowing again among themselves? What kinds of indicators can we see to say, okay, things are moving along now?
Well, I think there's some real positives in the market today that you're starting to see kind of a sigh of relief. Yes, there's still a lot of volatility ahead of us, but there's been a collective sigh of relief. I'd point to a couple of things. As companies begin to expand and to change and to kind of look forward, keep their head up and look down the road for opportunities, that's when you know that we've kind of made a change, a mental change, if you will. The great example of that is, well, there's actually three. J.P. Morgan's acquisition of Bear Stearns was tremendously opportunistic for them, but they were looking down the road. The same goes for Bank of America's acquisition of Merrill Lynch. And lastly, and now a contested acquisition between Citigroup and Wells Fargo for Wachovia. Those guys are looking down the road after we exit the recessionary type environment that we're in today, and looking to make hay with it. And I view that as a real I think you'll really start to see the economy loosen up as you see more and more of those types of activities?
I'm not sure that the individual consumer will see anything immediately. This is a huge package, and the impact of it is the federal government is going to appoint 10 or 12 entities to allow them to help purchase these assets, primarily mortgage-backed securities that are in default from banking institutions. That will take probably between now and the end of the year, I would say, for that capital to start rolling back into the banks. And so immediate tomorrow, the next day, you won't see that happen, but I would hope that by the end of the year, you will begin to see a fair amount of capital flow back into the banks that will loosen up the liquidity a bit to allow institutions that currently may not have funds to loan will be able to do that by the end of the year.